Well, time now to talk about you and your future. Since the election, the stock market has continued to climb. News broke when the Dow Jones Industrial average topped 20,000 for the first time in history in January. Now, only to soar beyond that in the days and weeks to follow. So, what is going on with the stock market and what does it mean for your retirement account? Damon Roberts of Acute Financial is here to tell us. He and his partner, good to see you by the way, he and his partner Matt, actually they host their own weekly retirement radio show. Every Wednesday they join us here on Sonoran Living. So the question is, if you've got a 401k, you're kind of watching this bull market, you must be feeling pretty good about it, but we all know, Damon, what goes up must come down. So how do we handle the market right now?
Well, like you said, the only thing we can guarantee is that the market will go up and it will go down, but how and when it's going to do that is very hard to predict. And studies show that your average investor buys and sells at the wrong time, primarily because of emotion. And if we look at a few months ago, people were coming in our office and were scared to death about what the election was going to do to their portfolio. Now, fast forward a few months, the markets had fantastic returns, and so these people that made decisions to go super conservative based on fear are now wanting into the market because they've missed out on this performance. And bottom line, you have to take emotion out of the equation, and you need to build a comprehensive plan that's going to fit your stage of life so that up or down it's going to do what you need it to do, and you're not worried about what's going to happen with the stock market in order for you to make decisions.
And I'm sure based on what's happening, you get a lot of highly charged emotional phone calls coming into your office, but the benefit of having someone like Acute Financial helping us oversee our finances is that you're helping us and your client look at the bigger picture. Absolutely, you have to. We're able to look at overall objectives, when we're going to need the money, what the tax consequences are going to be, and how that fits into your goals and objectives to provide income in retirement that's going to last as long as you do. Yeah. Now, what about young people today who are smart enough to invest or save their money? Should they be doing things a little bit differently than those who are closer to retirement? Absolutely, yes. You know, you might have a 30-year-old and a 60-year-old who say that they both want moderate risk in their portfolio, but those portfolios have to look completely different because we know over time, over long periods of time, the stock market's going to give us, worst case scenario, 6-7% return, but over short windows of time, that may give us great return, but it also could be devastating. And so young people have time on their side, should be more aggressive. Someone closer to retirement has to have more precaution. Yeah, and speaking of that, precautionary measures, you guide your clients into the different levels of risk that they should obtain. Is that right? And then once you do that, because you know our lives change all the time, how do you assess that risk level based on your clients' needs? Well, an easy way for viewers at home to kind of gauge how much risk they should be taking is the rule of 100. You take 100 minus your age, and that should give you the maximum amount of risk that you should have in your portfolio. So if I'm 60, I only should have about 40% of my stuff at risk, and 60% should be in my safer investments. Okay. All right. You know what? It's safe investments. I don't even know what they are anymore today. Are there any? Well, if we define safe as something that has no downside risk, it leaves us with very few choices. We have CDs, which are based on interest rates, and even though the Fed's saying they're going to raise interest rates today, those CD rates are still going to be pretty low and aren't keeping up with inflation, so aren't a great investment. You've got bonds, which are also tied to interest rates in an inverse relationship, and so if those go up, then bond rates go down, and so you need to be careful in what kind of bonds you're buying. And that leaves us then with annuities. And annuities, there are several kinds. Some of them have a lot of risk, some of them have no risk, some of them have high fees, some of them have no fees. So you got to kind of understand what you have and what you're buying. That's right. Or have somebody who knows what they're doing. That's what I prefer. That's right? The best case. How about that? All right, so if you have questions about how you're invested right now and you want to sit down with Damon and his team at Acute Financial, have them take a look at your portfolio, here's what you can do. You can call the number on your screen right now, and what they're going to do is give you a complimentary retirement consultation. The caveat here is you just need to be at or near retirement in order to qualify. Here's that phone number, 480-620-6907. Learn more at acutefinancial.org. They have locations valley-wide.